Good morning and welcome to today's webcast, December 2025 Tax Update for Not-for-Profit Organizations. Before we begin, I'm going to play a brief housekeeping video.
Welcome and thanks for joining us. Our webcasts are designed to help elevate your business performance. Transform your future for the better with advisory solutions tailored to your vision and supported by our collective technical resources. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget. You can ask our presenter questions during the webcast by typing a question in the Q&A window and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% or 3 of the 4 polling questions, which we'll ask throughout today's presentation. Polling questions will appear within the slide window. To participate in the polls, please click on your answer and be sure to hit the Submit button to record your response. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry, if you can't download your CPE certificate today, we'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our group CPE attendance sheet to receive credit. The attendance sheet is available in our slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit only can be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Before we get started, I wanted to share our big news that Moss Adams and Baker Tilly have joined forces to redefine accounting, tax, and advisory services for the middle market. It's really exciting, and you can read more about it on our website from the link in the console. Now, I am pleased to introduce today's presenters, Patty Meyer, Director, and Ryan Stedman, Senior Manager. With that, I'll turn it over to Patty to get us started.
Thank you. All right, I'm so glad everybody could attend our webinar. Our agenda today, we're kicking it off with the One Big Beautiful Bill Act and tax effects for tax-exempt organizations. We'll also incorporate the Senate version differences that are out there that were just released about 10 days ago. And then also, we're going to talk about some other updates and then end it with IRS updates and other regulatory guidance. Polling question.
Okay. We'll start things off with our first polling question. How are you associated with tax-exempt organizations? A, officer or employee of a TE organization. B, board member or volunteer of a TE organization. C, professional advisor to a TE organization. D, other. I'll give you a few moments to respond. To participate, please click the button next to the answer you choose and hit submit. Okay, it looks like we have about 75% of responses here. I'll give this a couple more moments. Okay, and here are those results.
Okay, thank you. So it looks like the majority of people are officers or employees of a tax-exempt organization. We've got some board members, professional advisors, and others. Looks like a great group. Wonderful. Okay, so when I go OBBB Act, that's kind of how I acronym it, but the One Big Beautiful Bill. Here we go. So on an overview, so the House passed this bill. It was May 22nd, 25. It was very close. It wasn't passed like, whoo, everybody wanted it. It was very close within 1 or 2 votes. The last I read, it was 215 versus 2 yes, 214 no. So really, really close. June 16th, the Senate passed their text of the tax provisions that they'd like to see. So if the Senate passes the bill, it would return to the House for a vote, but the House and Senate still have to resolve any things that are different. So they need to look at it. And really the goal is they get something passed, otherwise they start all over with a reconciliation bill, and nobody wants that. We have a lot of things going on. And mainly what's happening is both bills are making revisions. We have the 2017 Tax Cuts and Jobs Act that was passed. A lot of those provisions expire the end of the year. So that puts a lot of pressure to say, hey, do we want things permanent? What are we going to do? So they're really taking a hard look at this and thinking. Several of the adjustments affect more the for-profit sector, a lot of the big ones. There's increasing the Section 199A deduction for pass-through businesses, deductibility of research and development costs. That's a really big one because they made research companies capitalize their R&D costs and amortize over a period of time, 5 years or 15 years, depending if you're international. There's 100% bonus depreciation and rollback of green energy credits. So when they do bills like this, they look at revenue increases and costs. So they don't want the costs to be too high, so they need increases in revenue. And so we're going to talk about the various provisions that affect exempt organizations. So what they did is they expanded the application of tax on excess compensation. We'll talk about that a little bit later. But the Joint Tax Committee does a lot of analyses when they come up with these bills. And their estimated revenue is, for this provision, is an increase $3.8 billion over the next 10 years. They're also looking at increasing the tax rate on investment income of private colleges and universities. This is estimated to increase revenues $6.7 billion over 10 years. They also want to increase the private foundation investment income tax rate. This is not in the Senate bill, so that's good for private foundations. We'll see what happens. But it's an estimated revenue of $15.9 billion over 10 years. And then we've got the parking tax. I don't know if you all remember that, but that is a hard one for the exempt organization, nonprofit sector, because you're paying a tax on expenses. So it's a hard concept. It may be disallowed in the for-profit sector, but ours, we pay tax on the cost. So this is not in the Senate version. It'd be great to see this not go through. It didn't affect every nonprofit organization, but it's a lot of work actually to figure this out. So hopefully that does not pass. Then we have exclusion from unrelated business income, research income. This would be limited to research that's available for the public. This is not in the Senate version. They made several energy credit termination and modifications to the Inflation Reduction Act. And then we have the retroactive disallowance of employee retention credit claims filed after January 31st, 2024. So right now was currently allowed to file through April 15th of 25. So basically taking that date away, moving it back to 1/31/24. In both of the bills, Senate and House, it extends the IRS, it gives them 6 years to audit investment tax credit claims. So it's usually a 3-year period. And it's enhancing penalties on promoters and fraudulent claims. Kind of interesting, the House version, their penalty provision for promoters seemed a lot bigger to me than the Senate vision. It could be the greater of 200,000 or 10,000 if it's a person, or 75% of the gross income the promoter got. And in the Senate bill, it was $1,000 for not doing due diligence with the taxpayer's eligibility. So $1,000 per occurrence. So they're quite different on the penalties, but they're both trying to do similar things. Another big one is 1% floor deduction for charitable contributions by corporations. Right now, a corporation can deduct up to 10% of their income as a charitable deduction. So it's dropping it quite a bit. They're estimating this would be a revenue increase of $16.6 billion over the next 10 years. The Senate, this isn't in the House, the next bullet point, but the Senate would like to add a 5% floor on contributions for itemizing for individuals that can itemize. So what that means is, I don't know if you're familiar with the medical expense deduction. If you itemize, it doesn't start counting until you meet this floor. So the floor is typically 5% of your adjusted gross income. What's that number? Starts counting when you exceed that. So that would affect a lot of donors that itemize. They may not be able to get the deduction anymore if that passes. There's, this is good news, a reinstatement of the non-itemizer individual charitable contribution. We've had that in the past. And on the House side, it would be a $300 deduction for cash contributions and $150 for others. It would not include donor advice fund contributions. And for the House version, it's only for a 4-year period, starting 2025 through 2028. On the Senate side, they would increase the non-itemizer charitable deduction to $2,000 and $1,000 respectively, and they would make it permanent. So Senate one sounds better for that side, but I'm not too excited about the 5% floor because I know that's gonna, I don't think it would stop people from donating, but they wouldn't be eligible for the non-itemizer deduction, I don't think right now. Rescission of tax-exempt status for nonprofits supporting terrorism. We'll talk about this a little bit more. It was actually taken out from the original House bill, and it wasn't included in the Senate bill, but we've got more to say about terrorism supporting organizations. And then there is a tax credit. This is new for individuals making contributions to organizations that are granting scholarships to private or religious elementary or secondary schools. So that is a new one. And on that one, this is a cost. The estimated cost is $20.4 billion over the next 10 years. Okay, and I'll move it to Ryan.
Great. Thank you, Patty. Yes, we're going to go a little deeper here in a few areas within the Act. So the first area we're going to explore is excess compensation. The proposed Act would amend Section 4960, which is the tax on excess executive compensation. This change would impact tax-exempt organizations that pay individuals in excess of $1 million. Under the current law, the excise tax applies when an organization's covered employees are paid compensation exceeding $1 million or when there is an excess parachute payment. This proposal expands the definition of a covered employee to include all current and former employees of the organization, and not just the top 5 highest paid individuals each year. So that is the change there. They're expanding the number of employees that could be subject to the tax. This means any employee receiving more than 1 million could subject the organization to that 21% tax. The idea here is that this change would create parity on the taxable corporation side under 162M. And this proposal is included in both the House and Senate versions and would apply to amounts paid or incurred after December 31st, 2025. The next area we're going to talk through is the excise tax based on investment income of private colleges and universities. So just to refresh, this is Internal Revenue Code Section 4968. It's also known as the endowment tax. It's a federal tax imposed on the net investment income of certain private colleges and universities. The tax currently applies to those meeting specific criteria, including having at least 500 tuition-paying students, with more than half located in the United States, not being a state institution, and possessing assets excluding those used for their exempt purpose with a fair market value of at least $500,000 per student. So under the current law, those being looped into this law, it imposes a flat 1.4% excise tax on the institution's net investment income. The proposed adjustments under the One Big Beautiful Bill Act include replacing the flat rate of 1.39% to the tiered rate system, and also a change to the definition of eligible students. So we'll take a look here at the proposed tiered rate structure based on endowment size per student. So you can see the value on the left-hand side, and then the House Plan and Senate version on the right. You can see the House Plan taps out at 21%, which is the corporate tax rate, and then Senate version taps out at 8%. So those are the two proposals out there. The additional proposed changes on the endowment tax are summarized here on this slide. Both the House and Senate proposed plans exclude visiting foreign and undocumented students from the count of eligible students. This is impactful because it narrows which students are counted for purposes of the asset per student threshold, and it makes it more likely more schools with high numbers of international students to become subject to the tax. There were also changes proposed to what could be included in net investment income that we haven't seen before, such as student loan interest and royalty income from intellectual property developed by students and faculty members using federal funding. The bills exclude qualified religious institutions from being subject to the tax, but preserves the exception for private colleges. The Senate version also exempts schools that don't accept federal financial aid from being looped into this tax as well. And then the proposed amendments also add a reporting requirement to Form 990 regarding the number of students included in the calculation. We're also seeing there's anti-abuse rules where the Secretary and the Treasury would be directed to issue guidance to prevent the tax through the restructuring of endowment funds, or to reduce or eliminate the value of the net investment income or assets subject to the tax. So definitely something to watch there. The amendments will apply for taxable years beginning after 12/31/25. So for fiscal year-end organizations, it would apply for tax years ending in 2027. pass to Patty to talk through some proposed changes on the private foundations.
Thank you. So the private foundation tax is the tax on net investment income. For those of you familiar with the private foundation return, this is your net income on the first page of the 990PF column B. Right now, it's taxed at 1.39%. They want to go to a tiered structure, the House, not the Senate, and it's really increasing it quite a bit. We had this a long time ago before we got a flat rate of 1.39%. It used to be 1 or 2%. And some of the issues with looking at kind of a cliff structure is that if a foundation's net investment income is teetering between the two percentages, then with their asset count, then it could push it, it could double it. So as you see below the first, right now up to 50 million of assets, it's 1.39, doubles to 2.78 if you're over 50 million in assets but less than 250. Then it jumps to 5%, up to 5 billion, 10%, 5 billion or more. What also, it's just going to be hard to plan is basically if you're in between. The other thing is the private foundation's assets are not going to be reduced by liabilities for this calculation. When you look at other calculations that comes up on a private foundation return, there's a minimum payout distribution analysis, and their fair market value of assets are reduced by liabilities. For example, you might have a building, it has debt, you're reducing it. It's not telling us if we can exclude assets held for exempt purpose. So there's a lot of things that it doesn't follow the same logic, but so you could still be subject to the tax even if the majority of your taxes you have them because they're tax related, and normally for the distribution requirement, it wouldn't even come up. The other big one is it wants to pull in net investment income and assets from certain related entities. This is brand new. So it's looking at control. Does a foundation control other organizations, or are other organizations controlled by the same persons? So that could bring in assets, net investment income that the private foundation would need to pay tax on. If you have two private foundations, controlled by the same people, you wouldn't count it twice. Each one doesn't have to pick up the other one. But and there's also an exception for investment income that aren't intended or available for use for the benefit of the private foundation wouldn't be taken into account unless the private foundation controls it. So there's no definition of control, and there's no definition really of intended or available use for public. So it's unclear if would this include only other 501c3 organizations, or are you going to be bringing in for-profit organizations as well? So that's a lot. I'll move it back to Ryan.
Great. Moving on to cover green energy credits that were enacted as part of the Inflation Reduction Act of 2022. The proposed act would significantly curtail both residential and commercial clean technology tax benefits through accelerated sunsetting of those credits. They also introduced some complex new eligibility restrictions relating to involvement through ownership or material assistance by prohibited foreign entities. And we're not going to focus on all the credits because there's just so many under these green energy credits, but rather we'll just focus on the ones that we're seeing are most relevant with tax-exempt organizations. And I'm going to refer to some Internal Revenue Code sections here. So 45W, this is the electric vehicle credit. This is currently a credit for qualified commercial clean vehicles acquired before 2033. The credit is dependent on the weight of the vehicle, but really ranges from 7,500 to 40,000 depending on the weight of the vehicle. The legislation proposed eliminates the credit for vehicles acquired as early as 180 days after enactment in the Senate version, or starting in 2026, as noted in the House bill. Similarly, 30C, this is the alternative refueling property tax credit. It is a credit available for installing electric vehicle charging stations acquired before 2033. It's currently a 6% credit or a 30% credit when prevailing wage requirements are met. Under the proposed legislation, there would be an elimination of the credit that is placed in service as early as 12 months after enactment of the Senate version, or starting in 2026 as noted in the House bill. So definitely comparing, 6 months or a year compared to what we had before, which is 2033. So definitely some accelerated timeframes there. Moving along to a couple more credits, 48E, this is the Clean Electricity Investment Tax Credit, is based on the cost incurred on eligible properties such as solar panels, wind turbines, hydropower facilities, geothermal facilities. It's a 30% tax credit under certain megawatt capacities with enhancements that can increase the credit up to 50% under certain criteria. And under current law, you do have until 2032 to place in service, but under the proposed legislation, they're really looking to sunset on projects that begin construction more than 60 days after the enactment or placed in service after 12/31/28. The Senate version allows for phase outs for projects that begin construction in 2026, and they do vary based on the property type. So a little gentler version for the Senate, but still, different compared to that 2032 date we had prior. And then finally, the 179D, energy efficient commercial building deduction. This is actually not a credit. It's a deduction for designers of commercial buildings that are owned by tax-exempt organizations. The engineer or architect, for example, will take the deduction in the year the building is placed in service, and it adjusts the overall price or economics of the construction project in exchange for that transferred deduction. It currently doesn't have an expiration date, but was enhanced. The credit was enhanced through 2032. The Senate now proposes the elimination of the deduction for property beginning construction more than 12 months after enactment, and the House doesn't have a proposed amendment at this time. So the takeaway is really just not too late to start on many of these projects, but if this legislation is passed, time is certainly a concern. And just a reminder of the process of how you would claim the credit is once a project is placed in a service, you would complete a pre-filing registration with the IRS. You would use that registration number with the IRS on the tax return as part of making that elective pay selection. And you would submit the appropriate credit form with the Form 990T for the year in which the property was placed in service. I think we have a polling question here.
Thank you, Ryan. This is our second of 4 polling questions. Do you think the Senate will approve the House version of the One Big Beautiful Bill Act without any changes or adjustments? A, yes. B, no. C, nice try. The Senate and House rarely agree on tax law. As a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions.
I like the snarkiness in answer C, but my answer to this would probably be no. I do think there's going to be a lot more change. I do anticipate more changes coming.
Okay, it looks like we have about 90% of our answers in. Last chance to submit your answer if you haven't already. Okay, here are those results.
Yep, it seems like everyone agrees there'll probably be some changes on the horizon. Okay, we're going to quickly touch on some other updates. So the first up is executive orders impacting non-for-profits. Since taking office in January, President Trump has signed a series of executive orders and memorandum that have attempted to redefine federal policy in several areas. Some of these executive orders can significantly impact nonprofits, particularly those that rely on government funding and engage in activities like immigration or diversity, equity, inclusion initiatives. Executive orders reducing the workforces of agencies that not-for-profits depend on can also be very impactful. The recent executive orders, proposed legislation, and other investigations have brought a new focus on nonprofit organizations that could be seen to be at odds with national public policy and shifting definitions of illegal activities for nonprofits. And we're not going to dive deep into the legal issues that are popping up here, but we do encourage organizations to meet with your attorneys, assess current programs and activities to identify potential areas of concern or where compliance might be questioned relating to executive orders and make adjustments as needed. You can also run a risk analysis to understand the exposures, and we do really encourage a review of the Form 990 with your attorneys prior to filing this year. That is a public document and is filed with the IRS, so definitely encourage more review and consideration this year on the Form 990. We're also encouraging everyone to stay informed, monitor the news and guidance from organizations like the National Council of Nonprofits and other state-level associations to stay up to date on the current changes. So this is an example from the National Council of Nonprofits Executive Order Tracking website. It provides a summary of the potential implication and current status of each order, and maybe you are all very aware and tracking already, but I just wanted to share this. I thought it was such a great resource, and it does such a great job of tracking the updates as well. I'm sure you're aware that many of these orders are being challenged in the courts, and so it's a great way to stay up to date on the orders that you are interested in that could affect your organization. It's also important to be aware of other initiatives beyond the executive orders. There are also civil compliance investigations and examples of state attorney generals asking for information directly from universities to determine whether its DEI programs are consistent with law. I'll pass it to Patty to talk about other legislation and investigations referencing illegal activities and significant litigation.
Okay, thank you. So when I was going over the One Big Beautiful Bill Act, I mentioned the rescission of tax-exempt status for nonprofits supporting terrorism. So that was stricken from the House and wasn't in the Senate bill. But on the House version, which was stricken, what they wanted to do was to allow Treasury to designate a nonprofit as a terrorist supporting organization and revoke the status with minimal due process. So, and then what they were also looking at was, well, we'll exempt certain humanitarian aid with approval from OFAC, which is Office of Foreign Assets and Control, and will require additional disclosures. But if we step back in time a little bit, this was a bill, 9495, that was passed by the House, and it was also trying to establish immediate process for suspending tax-exempt terrorist supporting organizations under Section 501P. So 501P looks at terrorist organizations and denies a charitable deduction to them. And now they're trying to expand to a supporting terrorist organization. And this is defined under HR as that this organization has provided during the past 3 years material resources to a terrorist organization as defined in 501p. The problem that a lot of people are having with this, with kind of how it was set up in this bill, is with their expedite process, it doesn't even require an IRS examination. And it's like, wow, you can just, say someone's a terrorist organization, and maybe they are, but there's a lot of things that they might need to handle this a little bit differently, but it's still being looked at. It's not in the bill right now, but on the next slide, this is pretty interesting. So on June 12th, the chairman of the House on Homeland Security, Mark E. Green, and subcommittee oversight, the committee person, Josh Brecken, they sent letters to more than 200 non-governmental organizations, NGOs, providing humanitarian relief to immigrants on June 12th. So the letters are basically accusing these NGOs as incentivizing and facilitating illegal immigration and encouraging unprecedented levels of human trafficking and smuggling. So over 200 letters were sent, and so they want to get more information on this. So the letters that were sent, for example, they were asking questions like, do you get government grants, contracts, disbursements? How much have you received from the government? Are you in any lawsuits against the federal government that are petitioning? Did you file any briefs against a lawsuit brought against the federal government? Do you assist illegal immigrants or companioned alien children since January 2001 and more? So certain NGOs are advising and training immigrants to avoid immigration officials. And they have an undercover video that exposed an NGO of providing over 55% of its grants for this type of training. So they really are tracking it. An example of some of the NGOs that received this letter are Catholic Charities USA, the Coalition for Human Immigration Rights, Global Refuge, Endeavors, Make the Road New York. I mean, there's more, but those are some pretty big ones that are getting this letter. So we'll be seeing more on this. It's definitely on their minds, and they want to get a handle on this. Okay, so Loper Enterprise, this case was very, very important in tax law and actually the whole government, like how we look at things. So Chevron was a Supreme Court case, and it's over 40 years old. It was ruled in 1984. And what this doctrine had required the courts, if you went to court, they had to defer to a governmental agency's reasonable interpretation of a statute that the agency needs to enforce. So basically, it's their interpretation of Congress's intent. What's the intent of Congress? The agency would look at this. So, in the tax side, we have the IRS. Well, when they change the law, it goes into the revenue code, and then there's regulations and other guidance that are provided by Treasury. And those are interpretations of what Congress intended. So what it was held was that now the courts have to use their independent judgment to decide whether an agency acted within its statutory authority, and that the courts may not look at the agency's interpretation simply because the statute is ambiguous. So it's really saying the whole court needs to figure this out. The agency, they can look at it, but that's not the decision making. It's what the courts think. So This is huge. This is huge. It's not just for tax law, it's for really anything, any agency, what they're doing. So for us on the Treasury bills, Treasury regulations, it's like what regulations offer guidance. They even offer guidance. What's the definition of charitable? It's relied upon by what the regulations say. So it's going to have a lot of impact, most likely going to lead to a lot of court cases. And then some of the things I read, it's like people are going to shop where they want to file, what court they want to use, what jurisdiction is that in. So it's going to be a big thing. It's a big change to how we look at the law's interpretation, what we can rely on, and then the courts can change it if it's ambiguous. Okay, over to Ryan.
Okay, great. From here, we're just going to quickly touch on a few updates to topics you may have seen in past tax update presentations. And the first is the name, image, and likeness licensing, or the NIL. So refresh on name, image, and likeness. It refers to the ability of individuals, particularly student athletes, to profit from the commercial use of their identity and personal brand. In 2021, the NCAA adopted a policy allowing student athletes to be compensated for their NIL without impacting their eligibility. NIL collectives were established by donors and fans of university athletic programs to fund the NIL deals for these student athletes. And some NIL collectives that were formed, they were formed as nonprofit entities and were granted tax-exempt status under 501c3. And in response, in 2023, the IRS issued a general legal advice memorandum, or what's called a GLAM, to address the NIL collectives and see if they further an exempt purpose under 501c3. They did conclude that many organizations that develop paid NIL opportunities for student athletes are not tax exempt. They're not described in 501c3 because the private benefits that they provide to the student athletes are not incidental. And then moving on to 2025, there have been a few developments in this area. And over the years, states have passed their own laws regulating the NIL licensing for college athletes, and just resulting in an uneven patchwork of rules and regulations in general. But there was a recent settlement that allowed certain colleges to directly compensate student athletes for their NIL. The settlement agreement establishes the College Sports Commission with the intent to standardize and enforce the approach to athlete payments, including these NIL payments. So the commission will enforce the settlement agreement's revenue sharing provisions between schools and their athletes. Under this framework, schools may distribute portions of their revenue from ticket sales, sponsorship revenue, media rights, and can include paying players directly for their own NIL rights. And from a tax perspective, we really just recommend attorneys and CPAs work together on the structure of these deals and continue to watch for further litigation. There will also be IRS and state informational reporting requirements if there are payments being made, and just to stay aware of when there's a payment to a student athlete. It could involve Form W-2 or 1099 where their services are connected, or if it's structured more as like a royalty, there could also be a 1099 MISC there to consider. Over to Patty.
Okay, proposed DAF regulations. So there's really no update for 2025, but if we think about the DAF regulations, DAFs were defined back in 2006 under the Pension Protection Act. It took 17 years to get regulations, proposed regulations. So these came out, And there in November of 2023, there was a lot of pushback. So many people were upset and weren't happy with the proposed regulations. They held a hearing May 6th and 7th, 2024. And they're going to be effective for the year's final regulations come out, but we don't know how long that's going to take. It could take a very long time just because so much is changing, in our country with tax laws, executive orders. Everybody's thinking about so many things going on. One big beautiful bill, all that. So these final regulations are going to come out, and because there was so many controversies and further explanation needed. A lot of people, you have to talk about this, you didn't talk about that. Some people think they should just start over and incorporate all of the comments, and try to make it a better proposed regulation before it exactly goes to final. But we don't know. So a donor advice fund is basically a separate identified fund that a donor contributes. It's owned by the sponsoring organization that holds the DAF. The donor has advisory rights. So it could be one donor or a couple donors. They have privileges on, and they could also have advisory privileges on, the distribution of the investment amounts. They recommend where it goes. Well, the proposed regulations right now are primarily definitional. They define a donor advice fund, donor advisor, advisory privileges, and taxable distributions. But within what they've defined, there's a lot of questions. And, it may be tapping someone that really shouldn't be in that donor advisor group or taxable distribution. So there's a lot going on. It also isn't talking about other issues that have been a concern and have been talked about. And one is a private foundation being able to meet its minimum distribution requirement by donating to a donor advice fund, setting that up. There's also questions on, okay, you guys, what about more than incidental benefit? Pledges, bifurcation of payments, so more information on that, where more than incidental benefit would cause a tax. Public support, they haven't talked about that. That's been kicked around, meaning that if a donor advice, your donor advice fund is held by a 501c3 charity, like a community foundation, and you advise the community foundation, I'm the donor, donate to organization X. Well, organization X can treat this as, this is good money for my public support testing because it came from a community foundation. But they're talking about, no, it came from the donor that set up the donor advice fund. So it could create public support testing issues for the recipient of these grants, nightmare for tracking everything and all that. They also don't talk about payouts. There's been a lot of criticism that donor advice funds don't have a minimum payout distribution requirement like a private foundation, or they can be inactive and not do anything and just sit there and the donor got an immediate deduction. So those kind of things, we don't know where they're going to go. Here's some things, definitions of a DAF, scholars that aren't included as a DAF, a single identified organization, scholarship funds, etc., disaster relief. I'm speeding up a little bit because we're getting close to time. But basically, this is one, the ACE Act, that there's no update in 25. But here's where they were trying to do restrictions on when donor gets deductions. You have to have a payout requirement of, if you pay it out in 15 years, you get a deduction. Are you a qualified DAF? Do you have a 5-year payout or a 5% payout requirement? So all sorts of things. But this hasn't moved. Polling question.
Okay, this is our third of 4 polling questions. When do you think the One Big Beautiful Bill Act will become law? A, it will become law by 7/4/25. B, it will become law by 7/31/25. C, it will become law by 9/30/25. D, it will not pass and Congress will need to start over with a budget reconciliation. For those of you who would like a copy of today's slide deck, you can download one from the folder that says slide deck and handouts. We will also be sending the slides via email after the webcast.
Yeah, the president has been very vocal about wanting to pass this act by July 4th. So we'll see what happens. We'll see if you agree with that date. And then September 30th is the end of the federal fiscal year. So how this bill was introduced, it was introduced using the budget reconciliation. And so it would need to be passed by 9/30 in order to, within the federal fiscal year in order to become law. So it's interesting, those two dates that I'm interested in tracking.
Okay, it looks like we have about 90% of responses in. This is your last chance to get that question or your answer submitted. Okay, and here are the results.
Looks like we do not have confidence in July and it passing in July. I like the attitude here. Yeah, there's a lot to sort through on their end. So we'll see what happens. Stay tuned. Okay, we will quickly go through some updates on what has changed at the IRS in 2025. This is a copy of the U.S. Treasury Inspector General for Tax Administration report that was released in May of 2025, examining the details of the reduction in workforce that the IRS has been experiencing since dismissal of probationary employees and the deferred resignation program. So you can see that the report found that the IRS has seen an overall reduction in its workforce by 11%, and with even larger reductions in specific areas. You can see the stats by the business unit and job type. The TEGE, or the tax-exempt governments entities unit, which is a unit that contains a specific focus on exempt orgs, saw the most notable decrease of 31% in its workforce. And the number of revenue agents, those who are responsible for conducting IRS taxpayer audits, was also reduced by almost 1/3. So you can imagine the impact we're really bracing for here. I think we'll move along to polling question number 4.
Thank you, Ryan. This is our final polling question. With the IRS workforce reduction, will you, A, take an aggressive position because no one is watching, B, stay calm, be transparent and patient with resolving IRS issues, C, be proactive in anticipation of an IRS exam by preparing documentation, following tax updates, and reaching out to your tax professional, D, change nothing. Once you have completed all CPE requirements, you'll be able to download a PDF of your CPE certificate from the CPE progress window.
I hope answer A is not a high percentage. That's not what we want to see in this, obviously. So please don't select A.
Our favorite is C, Ryan and mine.
Yes.
Okay, it looks like we have about 75% of responses in. I'll leave this open for another moment here. Okay, and here are those results.
Okay, so staying calm, that's good. I like that there are people that want to be proactive. That's a really good sign. I think the main thing is just to do the best you can with the documentation of your positions and all of your information. There's so much, pressure going on right now with all the executive orders, laws changing. But yeah, transparent, patient with the IRS resolving issues. That is so true with the workforce decreasing, and so much of their knowledge-based individuals have retired in the TEG sector. We're training basically a lot of the representatives that we work with, and it's just getting more mistakes from the IRS is what we're seeing. Okay, the TEGE issues an accomplishment letter, and they have a fiscal year end. And these are highlights, but a lot of it's, you'll see from the next slide, or actually a couple slides down, but they are collaborating with technology and they're trying to modernize a lot of their systems. I mean, they get faxes still from us. So they're not as updated, but they're working on it. They had more money coming to them, but that's not there anymore. Electronic uploads. They're still working in partnership with RAS, which is their research applied analysis statistics, and they're developing AI. So that should help them. That's how they measure risks, and it could cause correspondence letters coming from the IRS asking questions to your organization if they think something is not in compliance. They also work with other business divisions and they've really taken a really good look at the elective pay that organizations, they have the information, they know how to, they can register when their project is completed and all that. Also working with, things like that. So I'm going to just move on. There's more you can read. Improvements for the user's experience. Well, they're still working on this, but they are trying to have frequently asked questions, data, more links. You can go to that website. And this is the sad one. They had a very successful major hiring initiative and they added more people, but as Ryan pointed out, that's not really how it stands right now. Okay, Ryan.
Okay, I'm going to zoom through some of these and you can peruse them on your own leisure, just in the interest of time. I do want to pause here on this examination graph. This slide is covering the examination stats for fiscal year ending 24. So this is the September 30, 2024 statistics. The key takeaways here is that we continue to see high change rates on examinations at 74% and also pickup. So meaning if you're being under exam for one issue, IRS can often pick up another issue that they see on audit. The total number of exams that were started was 3,200, and that was a significant increase over the prior year. We're anticipating that that number is going to decrease in fiscal year end 25, just because of those decreased IRS staffing issues. And another thing to take away from this slide, and very interesting, is that the process in which the IRS identifies returns for audit is, we keep hearing that it's, data driven and triggered by technology, but actually what we're seeing here is that the most are received through referrals. So the state AGs and the whistleblowers are actually referring issues to the IRS. And so just important to note that the state AGs are out there and they're watching and can tip off the IRS. I think we are unfortunately out of time, so I'm just going to zoom through to the last slide, commenting on IRS response times. We're really starting to see this trends of communication with the IRS responses being delayed, backlogged in communications, and the substances of those responses are varied. So definitely recommend reaching out to your CPA, reaching out to the tax advocate office as well. So if you haven't been there, it's a office within the IRS that actually helps taxpayers resolve issues with the IRS. So there's a link there. And with that, I'll turn it back to Keeva to close us out.
Thank you so much. Thank you, Patty and Ryan, for a great presentation today. If we didn't have time to answer your questions, we will do our best to follow up with you after the webcast, but please feel free to reach out to either of our presenters if you have additional questions. We invite you to visit our website for more resources and information on this topic, many of which are linked in the handouts window. Finally, here's a link to the survey for today's presentation. Your feedback is always appreciated. Thank you again for joining us, and take care, everyone.